They don't seem that difficult. Ding ding, the day is done. All right, well that's over. So Netflix, I know a lot of people want to ask about this. So Netflix kind of closed in the range where I'm still okay with accumulating additional short interest, but it did close below gamma neutral. And today's upside test saw a pretty significant amount of selling of covered calls at 4.8, or well, just calls. Let's say calls at 480 and 475. That helps trim down vol. It cheapens puts and encourages more downside accumulation. So we could see another day in this range, but I think we might get a continuation tomorrow and start to move down further towards that psychological level at 40.60, 40 to 40.50, which is pretty important. I would say 40.46 is far more important, but this finding support in this range, we'll see. It could move very quickly. It may take some time. Tesla, I know everyone's going to ask about this one. Tesla closed the day at 238, which is the first level, ironically, at which I'm really actually comfortable shorting it. Continue breakdowns from here. You want to see a break of 233, then 220 to really open up the downside. But it's definitely a breakdown. The trend is broken. It retested and rejected, so I would say it's a confirmed breakdown. And we could start looking out even to this trend for a bottom. And this could potentially go much further down than simply like 220. 220 is like delta neutral, right? So if it breaks through resistance there, it could fall all the way down to there, like into the 180 range. So a lot of room on that. That's why I've been so cautious about waiting to enter it, is because I wanted to make sure that I got in at a point where I could get exposure to that whole downside range. QQQ down 100 basis points today. Still a significantly larger move than SPX. So we're seeing tech lead the way in these sell-offs. Except today, no breadth coming in to support the market like we saw yesterday. Now, while some of the bigger tech firms, Amazon, Google, I think notably, and Microsoft managed to hold up today, the rest still continued to sell off. And we may see that. We may see them kind of like fluctuate where, like Apple and Nvidia will have a strong day and then, Google and Amazon sell off. But I think ultimately, broadly across the Mag 7, we're seeing a fairly consistent rate of sell off in all of them, even with the small recoveries that we saw today after yesterday's massive sell off. And as long as breadth continues to fall away and not come in and support those flows or any positive flows, I think we'll continue to see deleveraging. SPX closed just a bit below my downside target for the day, closing at 47.05 instead of at, delta neutral here on the monthly contract. I don't know if you guys can see that blue line here. This is DN SPXW. This is GN SPX, so this is the AM contract. Notably, these are usually far larger in value than the SPXW contracts, and SPXW tends to have its concentration of interest nearer the current expiry, right? So SPXW tends to be a little bit more front weighted, and then SPX tends to be like the longer dated, larger positioning, bigger dealers and banks and stuff. So losing gamma neutral on the SPX chain is very significant, but losing delta neutral and closing below delta neutral on the SPXW chain definitely matters, especially in the short term. It's showing that the short-term shift is immediately bearish, which means more gamma. That means accelerated downside, right? But yeah, it's still roughly in line with our projections today, and interestingly, only like $1 off of my projection from Sunday. So everything's really going according to plan here. All three of us still well on track to see continued downside. Tomorrow we have ADP, Challenger, and unemployment data. So our continuing claims. And then we have services PMI. Services PMI is going to be far more important than manufacturing. If we start to see contraction in the services sector, which is largely responsible for all of the growth we saw through 2023, that's gonna really fuel the speculation on a recession into the middle or end of this year. So that could be very important. Keep an eye on that, especially without a lot of input from the Fed right now. That'll definitely scale scare people, and also with the yield curve so close to maybe uninverting. The other thing to pay attention to is going to be how the labor data looks in aggregate. Obviously, bulls and the soft landing narrative want to see labor weaken, but not substantially. So if labor weakens too much, it means the Fed over tightened, and that's going to cause panic. If labor is too strong, that means that the Fed doesn't need to cut rates. So there's really, like, the bulls really need kind of a tiny little Goldilocks zone where labor is a little weaker, but, very much in line with the labor market we've seen over the last year. They're going to want to see that for the next 3 months. And so that's going to be a really difficult needle to thread, I think. And I think it's going to be more likely that we see some extreme of that. I think we're probably going to continue to see stronger labor data, and the Fed isn't going to immediately have a reason to cut rates. And I would then say less likely is that the Fed is over tightened. I don't think they have, but it's a possibility. And we would be looking towards unemployment, especially, and continuing claims for an indication that unemployment's going to surge up. Obviously, a surge in unemployment is going to come with a collapse in revenue potential and consumer demand. So very, very sensitive period, especially for the data. Anyway, my expectations for tomorrow are that we're going to see labor kind of moderate, maybe slightly stronger, and that services PMI has a chance of contraction. Otherwise, I think as long as we don't see too much contraction in services or any big, surprises in the labor data, then we're likely to just continue following the trend, which is, I think that's where positioning is taking us. This is, largely just a mean reversion right now, but those data points have the opportunity to accelerate that, and so that's really what we're looking to those for. Commodities up today a little bit. Oil up pretty significantly today. 369 basis point increase on like crude futures. Dixie ran all day, got rejected at resistance. Pretty good chance that that continues up, breaks through, and we see that pull that top end of the yield curve back up again. Only the yield curve really only falling back with the rejection on that upside range of Dixie. I think we could see Dixie move to like 105 over the next few months, and that'll definitely pull the yield curve up. Correlation on the 1 and 3 month turning around now. Right now we're starting to see that vol flow out of equities. Equities are going down. Volatility on indexes is moving up pretty substantially. We got the VIX 3 month now at 1606, VIX cash at 1404 closing, with VIX futures at 147. This is actually moving to a pretty quickly to a point where VIX cash may be in backwardation with the contract in front on VIX. And we know what that means for VIX yield, right? That means VIX yield starts to move positive. Very bearish. Carry trade pretty much all the way up into the end of the day, and then down with the collapse in Dixie. I think this is going to continue to get leaned back into. I think banks need to lend a lot more. I don't think they're out of the woods yet. I expect that they're going to lean into this as hard as they can, and as soon as the risk is off the table of a rate cut, they'll lean into it even harder. So I think largely a big move here is waiting on FOMC and the BOJ decisions for January. I think if there's no indication of a rate cut in first half 2024 from either of them, then we're going to see them lean really hard into the carry trade. And that means tighter financial conditions. That means we're going to see that like yields up, VIX up, dollar up correlation that we saw prior back in August through October. Oil's probably going to be driven up by that, or at least oil will trade at a slightly higher level, like high 70s to low 80s. And then move, I don't think this is today's print, but we did see a big move in bond volatility yesterday. Today, I think it's a little bit more moderate or slightly down. Skews kind of reverting back now after we saw that big spike with all that vol shorting yesterday. We want to see skew continue to come down, and we want to see that 3 month correlation move up as the dispersion trade breaks down, right? And then lastly, This has moved to 27.33, so a little bit of the vol shorting breaking down today, and a little bit more correlation picking up between the VIX forward contract and VIX cash, but still very, very, very short vol, and definitely a high risk. Still far in excess of the period prior to Volmageddon, and even very close to the flash crash of 2010. So let's keep an eye on that, and just remember that Vega risk is huge on indexes right now, and with indexes trending down and vol trending up, that exposes that risk substantially. Yeah, we can take a look at the heat map for today. Pretty much nothing performing very well. Berk B a little bit ahead of the pack, but the rest of the financial sector largely down. Microsoft and Google outperforming the rest of technology services, all of which were down substantially. Electronic technology took a massive hit pretty much across the board. A few leaders in health tech, and then oil. Oil did moderately okay today. I would say communications and utilities, where we're looking for those defensive positionings, didn't really lose much or gain much today, so probably not a lot of rotational movement. Transportation, health, process industries, commercial services, all down. Those are all consumer services, consumer non-durables, retail trade. Those are all kind of indicating a weaker consumer, and I think that's part of an assumption that the JOLTS data is softening, right? Which it did a little bit, but not substantially. So that's what we're looking like for today. Tomorrow we're gonna open right at gamma neutral, and we got data in the morning, so we'll see how it goes. But it looks like we could see a continuation of this downside. So thank you guys so much for tuning in. I will see you bright and early tomorrow morning, 9 a.m. Later, guys.